Hi everyone, this is Michael Ben-Ghiat with Lifetime Investor, and this is the Market Trend Advisory Weekend Review video for October 1st, 2022. Before we start, here is our disclaimer. You can pause the video and read that. Okay, so this week we really don't have any change from last week. If anything, it's gotten worse, but we are in markets in the correction, and we have no exposure to either any index ETFs or to any individual stocks. And our market count is 0 out of 5, and market exposure is 0. So the overall market trend just continues to get worse. In terms of our investing strategies, the QQQ buy and hold is down almost 33%. I think that's the worst we have seen since the beginning of the bear market. And for the SPY, buy and hold is down almost 25%, and our market count 1x strategy has been basically holding flat for a while because we've been out of the market. For the QQQ, we're down 9.75%, and for the SPY, down 13.44%. So we're still beating the buy and hold by quite a bit, and we've just been out of the market to avoid all the carnage that's going on. So real quickly, let's take a look at the indexes. The NASDAQ closed about 10 points away from breaking below its June low. And it just seems pretty likely that sometime next week, probably Monday, we'll break below that and we'll go down into new bear market lows. But that's just my guess. It does look likely, but we might get some news on Sunday night and off we go. But it does look likely. This chart, which is a monthly chart of the NASDAQ, this is the one that I think is the most important chart you're going to see. And we've shown this numerous times over the last year or so. And this is just showing this was the internet bubble from 1999 going into 2000, breaking above this channel line, which had contained the advance, and then it got just overheated and exploded up from about, I think we were at, let me see here, about 4,000, 3,500. We shot up to 5,000 and then collapsed about 80% down over the next 2 years. And this kind of bubble mentality is exactly what we saw coming out of the coronavirus crash, with all that money and everything that they flooded the system with, just put the market into an overdrive mode, and really just, I think, has caused a lot of problems that now we're having to deal with in terms of inflation, interest rates. We have now just broken down below all support in terms of the moving averages, and it's quite ominous. I will not be surprised to see this bear market now go another year or so down and even break below this low here, which was looks like 6,600, down to the 6,000. So most people are going to say it'll never happen, but unfortunately, this is what markets do when they go into pretty powerful bear markets. They can do anything. They could reverse all of this, and it's not uncommon, as you see here. For not only did it take out this whole final move, but it basically erased most of the move that came from 1994, at least what you can see in this chart. So for this to just even go back to where it was in 2020, that would take us back down to the 6,000s. And I'd say that looks extremely likely given what's going on. But, that's my opinion, and that's what sort of history says may happen. Of course, anything can happen because the Fed, at this point has been very strong about saying they're not going to cave. They need to get rid of inflation, and they can't just cut interest rates and do what Wall Street wants them to do, so it does look like we're going to have a recession coming. How bad it will be, nobody knows. Just kind of looking at this chart, I would guess that the recession coming, just like we had over here, is not going to be a pleasant one. But my opinion, we'll see. Let's take a look now at the S&P. The S&P did break below its lows from June. Again, looks a little ominous. We're getting a lot of distribution. You can see here in the market. So institutions have been just bailing out. and we've now just turned over. All the moving averages are now facing down. Not a good sign. It doesn't look like there's any real support for quite a while. So this is also a negative look there. Here's the same chart of the S&P monthly. Now this one briefly broke above this channel a couple times in 97, looks like 98, and then and a little bit in 99 too, but just above. Now we sometimes see this in individual stocks. This is a very strong sell signal when you break above a channel, especially one that's been going on for years. And then it just kind of petered out. All the money went into the NASDAQ, where it just went, basically parabolic towards the end there. Here, though, we did get above it for a number of months, and now we've broken down below all the supports, including this moving average, the green one, which has really held most of this decline for a long time. We actually never have closed below it. Wow. I'd say we have to go back to 2007, 2008 to see a close below there on a monthly basis. So that's another ominous factor there. And again, it would not be surprising for this to come back and take out even possibly this low from 2000. 2020. So in the market's favor, though, we are starting to get, in terms of the technicals and sentiment, really pretty bearish. I mean, we're down again to just 17% of stocks above the 200-day moving average. That is really just, about as low as it's got before we had the huge rally in June. 52-week lows are just swamping the highs. I think we had one day where it didn't. I'm trying to find it here. Oh, here. And that was just almost, nothing. We had 68 highs, 62 lows. We're back down to very, very strongly below the moving averages. A number of stock breakouts were almost at zero. And we're getting just the down volume really is swamping. Now, we did have this one day on Wednesday where we had a just massive up day. Huge volume up and up on volumes, number of stocks. Down in volume, we had the ratio was over 24. I don't even remember seeing this strong of a ratio, back in even at the peaks. But it just didn't last, and we 2 more days of just down volume swamping the up volume. So, but we are getting to the levels here that are sort of been showing bottoms in the past. Now, especially in sentiment, which we have here. We are definitely at levels that have hit bottoms in the past. We're basically have the fear and greed, CNN fear greed. We're basically at panic here. The put call actually shot up to 1.26 on Monday. These were actually a day delayed. So this actually had come on Friday when we hit extreme fear here. We've become very bearish on the investors' intelligence numbers. It's just we have way more bears than bulls now. So overall, in terms of just sentiment, we're very close to a bottom. We can't call it the bottom because we had similar thing in June. We had a nice rally that really didn't do anything. In fact, leading stocks really didn't do much either. Eventually, before they all rolled over and taken us to today. So I'd say, overall, we are just in a bad bear market. If you're following our system, you shouldn't have any exposure, and you shouldn't have had any exposure for quite some time now. So this shouldn't be directly affecting your account balances. And we're just really on watch and wait mode. I mean, this wouldn't surprise me to go much lower with some sharp rallies in between. And I'd say really right now, if the market finds a slightest bit of good news, we are going to get a massive rally. Probably another 1,000 points up in the Dow, 400 or 500 on the NASDAQ. One of these things, and probably on huge volume too, showing institutions at least for one day came back in. Now, whether it lasts, we don't know. But that's part of bear market. So we're going to just continue to watch. And from the sidelines, again, should have no exposure at this point, but we seem to be getting near some inflection point in terms of sentiment and technicals, and we'll see what this week brings. It's not good news for market participants. but that's where we are. So we'll be back next week. Okay, thank you.